Hello, everyone. This is Mohammed Akif with Akif CPA. And then today we'll be discussing filing the first year US return as a Canadian who's moved to United States. So we'll be talking about the how the US system works, how what forms should be applicable to you. We'll be going through certain forms. Make sure that you understand those forms. We'll be going through some of the reporting requirements, and then we'll be discussing a lot of a lot of things in detail, such as for example, the ITIN, the reporting of the foreign assets. I made several videos about that too before, and then so we'll be discussing what is different type of returns that you can file in, what are the different types of returns that you can file in the US, what forms do they have, how is it different from the Canadian side in terms of, okay, how what the lingo is on the US side, so you get familiar with how things should be. So in a case where you are not the one preparing, someone else is doing it, so you have a general idea that this is how it should be looking. And then in a case where you can where, let's say, even if you are doing it, you can understand this is where I should be heading. So in both cases, where you have somebody doing it for you or you're doing it yourself, you have an idea how things should look like. And then so that's something I wanted to do in this video. This is my message, this is the whole purpose of doing this video. And then I was talking to one of my colleagues the other day, and then they were saying that, Muhammad, why you want to give this much information out. And then the whole point is that I want people to, because I've seen enough where there's so many mistakes that has happened. There have been so many missed information, wrong information, that has happened over the years, especially with Canadians when they're coming to United States, because we tend to follow the same pattern that we had in on the Canadian side. And then so we file, we get somebody on, when we get here, we get somebody on the US side. Hey, this, I'm here, this is my first year return, these are the things. And then what happens is not about you, it's about the tax preparer, it's about the accountant. So majority of the accountants on the US side will not understand how the Canadians, when they're coming to US, how things should be reported for them. So specifically TFSA, the tax treaty elections, the disclosures, the RSP, RESPs. These are all the lingo that we are used to as Canadians when we're coming to US, but not a US tax preparer. They're if you just go to somebody, even a CPA or H&R Block, you can name it. I'm talking about lawyers too in this case, where sometimes they are the tax preparers too, but you would see that they are not used to this lingo. And then so when they're not used to the hearing forms such as RSP, accounts such as RSPs, RESPs, TFSAs, mutual funds, you can start thinking, okay, does this person know what I'm talking about? Because these are common things on the Canadian side, right? So a person who's working with Canadians all the time, or majority of the time, understand these forms, understand the reporting, understand these accounts, and understand the reporting of these accounts on the US side, understand how the retirement accounts works, understand the tax treaty disclosures, which then that if you have spoken these words, if these lingos, these acronyms, and then they have picked up on it, then you can be comfortable. Yes, they are aware of what they're talking about. They understand how the reporting should be, because it is just not about understanding. It's also about, we have certain clauses, certain benefits, certain elections for Canadians only. So I wanted to make sure that I give a clear direction, a clear understanding of how the first year return should look like, where you have an idea. Okay, this is, if I'm doing this, if I'm getting filing this form, I should have at least these forms, right? Should have at least these things in the tax return. So if you are missing, then you can question them. Hey, this is what I have, and that this should have been reported, or why is it not being reported before the return is filed? So you at least have an idea. And then so if you hire someone, to at least you have an idea to if they're the right person or not, because you can talk about the retirement accounts, you can talk about the acronyms we use on the Canadian side, to understand if that the tax preparer or the CPA, whoever that is, understands the reporting requirement on the US side or not. So that's the whole purpose here. My whole purpose is to give an information, give a direction, give an understanding where you can understand how the first year return on the US side for Canadians who are moved to United States should look like. I'll be so at least have an idea. Doesn't mean that you have to do it. You can get somebody else to do it, but at least have an idea where things are heading because it is very important. I mean, you have moved to US. Of course, some in majority cases this is for work purposes, and so that means you want to earn more. There is a whole growth opportunity kind of thing on the US side, and then so with that, I mean, you want to make sure that you were able to take as much as home to, right? You were able to understand how this reporting works, and then you were able to understand the tax system where you can say, you know what, I've moved, this is how this is going to play out, and this is how we are going to be taxed. And then understand that is this working for you or not. So before, without any further ado, of course, I have made several other videos about Canadians moving to United States, tax planning, why is it important, if, how when you move from Canada, how the assets are reported, what happens to those assets on the Canadian side, what happens to those assets on the US side. So I've done a lot of videos on those. Have some due dates videos, uh, talk about your rental property, principal residence, tax, filing the final return on the Canadian side. That's all the information that I have worked on. So today we'll be discussing the U.S. return, the first year U.S. return, and then how that should be, and then what are your options, what forms. Let's say if you are moving on, different visas, which should be TN, L1, E2. If you don't have, if your dependents don't have ITN, what forms can be applicable to where you can get the ITNs for them. It means you can get credit for some of the other credits that is there available. So I want to get into this, understand how this works on the US side. So let's get started. Okay, so let me share my. So I'll be doing a lot of sharing, screen sharing today. So we have an understanding of how things are, and then make sure that we understand the publication and then how it works. So let's get this started. Whenever you move to US, it doesn't matter what month you're moving. I can we can pick up any month. The U.S. tax residency is really based on a test, which is a substantial presence test, and then this test is a combination of multiple years in terms of your presence in the U.S. Uh, and then, of course, we have so we have some certain exemption from those present in the US too. We have de minimis rules where you can exclude certain days. But let's get into this present test and then so how this works. I mean, in a nutshell, if you meet the substantial present test, that means you are considered a tax resident in the US. So the first day you are here, that's the day that is considered a starting date of the residency. So if you do meet the test, technically you have you couple options in terms of filing. If you don't meet the test, of course, we have another option to what forms you can use. So let's before we get into what forms and then how that should be done, let's get into the test and then talk about the substantial present tense and what it is. So again, what I just said, if you are considered a resident, uh, if you meet the substantial present test, you are considered a tax resident from the day that you were first when you first arrived in the United States. So in order to meet the test, of course, you have lived in the US for at least 31 days in the current year, 183 days during the third 3 year, which includes this year. So, and then the 180 days is calculation. The calculation is based on a percentage. And then what do I mean by that is that so number of days that you are in the US are counted in fully. The number of days that you were in a previous year, let's say, for example, this is 2024, this is 2024. So whatever number of days you were in the United States in 2024 will be counted fully. In terms of 2023, they will be counted at 1/3. And then in 2022, they will be counted at 1/6. So once you add up those numbers, that's how you get the 183 days. And then this is how the substantial present test is calculated. So I do have a calculation that I wanted to share. So for example, let's break this down into a real example. So let's say, for example, you were in the US for 120 days in 2022, 90 days in 2023, and 91 days in 2022 so far, right? So in 2022 you were here 120 days, 2023 you were in the US 90 days, and 2024 you are in the US for 91 days. So how this will be calculated for 2024, of course, we will pick up everything in 2024. 2023 will be calculating one third. I mean, so based on the one third, it will be 30 days, and then on for 2022 will be 1/6. So based on 120 days will be 20 days. So you add up all those days to 91, 30, 91 plus 30 plus 20 will give you 141 days. So in this case, if you have lived in, so let's in this case we're talking about somebody who came in October. This is what it's coming out to be, and then based on number of days that you were here in the previous years, they this example, the person doesn't meet the substantial present test. So if a person doesn't meet the substantial present, what happens? If they do meet the substantial present tense, what happens, right? So what options do we have if someone meets the test, and what options do we have if someone doesn't meet the test? I do want to point out one more thing, is that if you are coming on a green card, so it is a separate test. I mean, so if you are coming on a green card, we the test you could have not met the test through substantial present, but because of the green card, you'll still be considered a resident, depending upon when you actually. Even if you would have been approved, depending upon when you actually come here. So this is to get your passport stamp, and that's the day you become a resident. So for a green card, of course, things are a little bit different. This could be you could be here on any number of day. You could be here on the last day or the first day, and then you could be considered a full year resident. So the green card test is a little bit different. So these, the majority of stuff that I will be talking about will be for people who are, it partially will be for people who have green cards or coming through a spousal sponsorship, or so majority of stuff will be discussed in terms of visas, which is HLE, also you name it, which allows you to work in the US. The exceptions are, of course, the exempt individuals, which are people who on A or G visas, or teacher or trainee. They're on J visas, F1 visas, FJM, or Q. These are all temporary. These are all the exception to the substantial present rules. We have a whole criteria for those. I mean, so exempt individuals are any individuals on these visas who are in the U.S. They don't. They could be living here for a whole year, and then they're not bound by the special, the substantial present test. I mean, so people who are on F1, J, M, A, G, J, these J visas, these are all people who are exempt from substantial present test. That means they are considered a non-resident for U.S. tax purposes, and then they maintain residency back in their country. So, for example, a student who comes from Canada to U.S. to study, they will be still considered a tax resident of Canada, and will be considered a non-resident or for tax purposes on the U.S. side. Let's say if we were on J visa or F1 visa, and then even in some cases their spouses too, so it gets extended. So there's a different category for those. We do have certain other requirements, but again, this is somebody who's coming and filing their first year return with students, and are not be applicable, or J, or all those visas will not be applicable for this video. So let's get into the detail of. Okay, so let's say if you have met the rules of substantial present test, with what forms can you file? So if you do meet the substantial present test, you will be filing. You have the option to file two types of returns. One is called a full year return based on number of days you have lived here, and then the other type is a dual status return. Dual status returns are more in complex, and then there are differences between a dual status return and a full year returns. Of course, a full year return, you're saying that even though you came here on another day, but you have the option to be a full year resident. You can file a full year tax return. There are certain things that come with full year versus a dual status versus a non 1040 and a non-resident return. So a person who has been here, it is a first year choice. So if you meet the substantial present test, you have the first year choice to file as a dual status individual, and then or a file a full year return. So full year return is a full year return. Of course, I will go into detail, but I do want to point out, I do want to go into detail of dual status return because dual status return is a little bit tricky. It is a little bit complicated. The way it's filed, it is a paper filing, and then it's not electronically filed. There's a lot of manual work into the dual status. So things do get a little bit messy with the dual status, where a full year 1040 full year return versus a non-resident return is they're much a less messy, easier to understand, and then we are able to get, we can e-file those forms, right? So dual status we cannot e-file. The full year and the non-resident is what we can e-file. So dual status, I mean, so if you meet this substantial presence test, in the following tax year, you may be treated as a dual resident for this. That means, you're continuing to be a U.S. resident uh, uh, from the year that you are actually filing for. For example, you came in 2023 and you're still a resident in 2024. Of course, you can qualify to be a dual status return, the dual status person. And then so technically, what is a dual status? So dual status is, partially the year that you're filing, partially you are a non-resident, and then you're becoming a U.S. resident. So the year that you were non-resident, of course, this is all something that is exempt from U.S. taxes. So any income that you earn from foreign sources, not from U.S. sources, not ECI. So these are all, nothing will be reported. And then the day you become a resident, that's from that day on, your worldwide income will be reported on the U.S. side. That includes, your interest, your wages, dividends, you name it. So there is a great publication 519, that you can read into, where it gives you quite a bit of details. What is a dual status individual, how this should be, they're good in terms of giving you information. I'm not sure how good it is in comparison to the Canadian forms, because I work extensively on both sides. I feel that the CRA gives you a better instructions versus the IRS. The IRS instructions are a little bit more complicated because they're things are being referred back and forth. But I feel that CRA gives you a better format in terms of instructions, where a normal person can understand what needs to be done and how things are happening. So for in this form, so this is a publication 519 that I have opened up, and then I'm going through certain things here, where if you are dual status, I mean, so technically, again, you were a non-resident at the beginning of the year. So this is people who are coming into the country, right? So this is not about people who are leaving the country. So this is Canadians who are coming into the US, and this is your first year of filing. So we're talking about, you were a non-resident for part of the year, you became a U.S. resident at the end of the year, or you were, let's say you got married to a U.S. person at the end of the year, then you can choose to file a dual residence return. This is also, doesn't have to be. I know in this instruction they're saying that these are the only ones, but if you go further down, again, the whole the whole game of the tax laws are the exception to the exception. If you understand the exception to the exception, then you can understand what the whole law is and what the instructions are. This is a whole point. I mean, so when you're reading tax form instructions, make sure to read the exception side, because that's where the if is there, right? So if this happens, this could happen. If this happens, this is also possible. If this happens, this is also possible. So make sure that you read the exceptions. Just don't follow the general instructions. Make sure that you read the exceptions. So even though over here there in general instructions, we're talking about if you're married to a U.S. person, you can file in these scenarios. In these scenarios, you can file a dual status return. If you are a single end of the year, you can choose to do this with your and you cannot make this choice if you're single, and then certain rules apply. But if you go down, if one spouse is a non-resident alien and the spouse is a U.S. resident, I know they're talking about U.S. citizen, but they're talking about U.S. resident. So in a case where one spouse gets here first, and then the other spouse joins them later, this can be also used at that time, right? So this is also one caveat that I do want to point out, where it's just not that you both have to be at the same time. If one person in one if you are married, if one person establishes the residency, the other person can join with them in that residency and make that election. So there's an election that you can make where you can file together, uh, on and then file a full year return. So dual status return, of course, these are again the manual returns, where we are on one part of the year we're saying we are non-resident, the other part we are saying we are a resident, and then we report according to the the income that we have earned during the residency sites. I do want to point out that all 1040 regular forms applications are, the requirements are applicable to the dual status, because you are saying that you have become a resident, that's what you're declaring on the dual status. So anything that is applicable for a regular 1040, which is a full year return, will be also applicable to the dual status return. And then, so what are the big differences between, hey, you know what, Mohammed, I know I'm a dual status person, but I maybe I want to file a full year return. How does it this how do we know what makes more sense, right? It all comes down to your income, your timing when you actually move to the United States, how this is going to play out. And then also, with the dual status return, you don't get any standard deduction. So that's something that I do want to point out. So you don't get a standard deduction with the dual status, and then you don't get a standard deduction with a non-resident return. So if you don't meet the substantial present test, then of course you can file a 1040 NR, which I think it will be a great form, because we're not reporting other information forms that are required to be reported, only focusing on the 1040 NR requirements. But the only downside to this form, there are actually a couple of downsides. One downside is you don't get a standard deduction. Technically, standard deduction is a similar type of a credit that is a basic personal amount on the Canadian side. This is how the equivalency is. So you're not getting that. So technically, when you are getting paid, the whole income becomes a taxable income. So because you don't get the deduction. In cases of non-resident, you only get the state. So any taxes that you're paid, you're only allowed to get itemized deductions, and then that's where the state comes in terms of state taxes paid. Again, a standard deduction versus itemized deduction is a whole new topic for Canadians. It is much different than how it works on the Canadian side. So this is something that I will be covering later down the road. So standard deductions, no question asked. Itemized deductions, we have a whole list where you can put the amounts down. We have certain thresholds that you need to cross to. And then if your itemized is bigger than the standard, then we take the itemized deductions. If your standard is higher than your itemized, then of course the default is going to be standard. But in cases of a dual status return and a non-resident return, we don't get the standard deduction. So we have to rely on itemized deductions. So which creates a problem in terms of taxable income. That means the tax is going to be higher versus the full year return. So what it comes down to is what makes more sense in terms of tax, what is more beneficial in terms of tax. In some cases, a full year return might be a better way to report rather than a dual status return. That's also the case, but we have to play those. We have to see how this is working out, because it also depends upon how the reporting is coming from the King side, right? So let's say if you have a home, you have certain retirement accounts, TFSA, RESPs, RSPs. I mean, how that's going to be affected, how that's going to be reported on the US side. So that plays a bigger role too in terms of determination which form to choose. But of course, we do this on our end, and then where we're able to see, okay, what makes more sense. We are able to see it quicker, but in your case, it depends upon how you're looking at things. So not everybody does dual status. I've seen cases where some people are doing it, some people aren't, some tax preparers are doing it, some don't. It depends upon who you go to. It takes time for determination, because we have to view your whole picture to say, okay, what makes sense in terms of tax. So again, when we are talking about 1040 NR, when we're talking about dual status, no standard deduction, only itemized deductions that we can deduct on our return to get to taxable income, versus a full year return where we can get all the credits, all the all the deductions that are applicable to us. So that will be the main difference in terms of your full year return versus dual status versus 1040 and R. All right, so let me jump into, so now we talked about 1040 and R. We talked about the regular 1040. We talked about the dual status. I do want to point out that the 1040, yes, let me just get to this form. So all right, did not meet green card tax. All right, so how is the income tax? Of course, the income tax is, the rates are based on, if you're getting the dual status return, then it's based on, let's say if it was a dual status all for your return, it is a casual rate. I mean, so it is what is being reported. I do want to say that the ITN makes a big difference too, where if you have dependents who needs ITN for the first year, that means, let's say for example, people who moved from on a visa, TN visa. Let's say for example, people who moved on L1 visas or E2 visas. There's, so TN visa spouses don't get social security numbers. L1 does. And then also the E2 visas, they also get this, the spouses get the social security numbers. But what about your children? So your children are not, they don't qualify until you file for the green card, but you do qualify for ITIN. So in what cases can we do ITN? So a full year return will get you the ITN numbers, where you can get tax ID numbers for your child, get some benefits, get some benefits too. In a case where in a case where dual status makes more sense, or non-resident makes, whatever is applicable to you, maybe putting off the ITN makes more sense to the next year than that year. You don't have to go through the whole thing of the first year, and then because this ITN only gives you certain credits, it doesn't give you the whole amount. So the credits are there, but at the same time, what is the impact, right? So you have to see that. And in certain cases, I think it makes more sense to forego the first year ITN, and then just do the ITN the next year when you're filing a full year return. Include a lot of the information. By the time you have settled down, you understand the things more. There will be more documentation for you to send it to the IRS. I do. Another point that I do want to cover is that whenever we are doing ITN with the tax return, it does go to a different address. It doesn't go to the normal addresses where the list is on the 1040, and it's going to the Austin address. And then so ITIN does have a different address when we are filing tax returns. But there's certain certification involved. There's some process involved. Then if we are mailing, it's a different one process. If you are going to the IRS office, another process. The documentation is there, and it's in some cases substantial based on what exactly is happening. So I think sometime in some cases I feel ITN makes more sense the second year than the first year. Yes, we want to get the most credit, that is all possible, but at the same time we are also getting to the system. So in few instances, I think it's better to go to the ITN the second year than the first year. That is my own personal opinion. So we have covered in terms of so if you do meet the test, I want to summarize this. If you do meet the test, we have two options. One dual status return. The other option is to file a full year return. If you don't meet the substantial present test, then of course the 1040 NR is the best way to go. In terms of the forms, this is what we need to move to. We have also covered the ITIN. So what forms we have where you can get the ITIN. So dual status, no. Non-resident return 1040 NR, no. Resident return, then this is where you'll be able to get the ITN number. So this is in terms of that, this is what it's. And so if you are full, of course, you have the option to do the full return. The only downside is that you will have to report your Canadian side too, and then of course the other reporting, the full year reporting requirements will be applicable. So now we've discussed the subtraction present test. We have discussed the forms. I do want to get into more reporting requirements. So now that okay, let's say for example, we know, okay, Mohammed, this is the form that is applicable to me. What other information do I need to report? What other forms do I need to look at in terms of reporting? So when it comes to Canadians, when it comes to Canadians moving to United States and the first year return, We want, the biggest thing that we want to look at is the foreign assets reporting, right? So we have reporting. So we are reporting this on a IRS form too. So, for example, 1040 NR, of course, this will be not applicable, but dual status return and a full year return, this will be applicable, where we will be reporting. The reporting of the Canadian assets is required, which includes your retirement accounts, which includes your non-registered accounts, TFSA, RESPs. This is something that is required. So there are two types of reporting that comes down to foreign reporting, and then I'll get into the TFSA too. But all your foreign assets owned in a foreign country, for because you are in the US, so that's the reason why I'm saying foreign. So it could be in Canada, it could be anywhere in the world. All your foreign assets on a 1040 return, on a tax and on a return that goes with the 1040, they're reported on 8938. So form 8938 is the form that is being used to report all your foreign assets. And then there's a list that I will go through. I'll share with the screen with you too, where where you can get more information of what type of how this should be reported. So 8938 is where this is being reported. There's in a separate filing, which is with the Treasury Department, the FinCEN, Form 114. That is a separate reporting. I know a lot of tax softwares will put it together, but essentially what is happening at the back is that 114 form goes to FinCEN and 8938 goes to the IRS. It is very important to know these are both are separate. There is a Schedule B form on the 1040. So on 1040, so you have a 1040, which is a full return or dual status. You will have a Schedule B saying that I do have foreign accounts. And it will ask you what country, and then you would list down what country. If you meet the requirements of the reporting, you will say yes, and then of course you have to report. You list down the number of countries that you have foreign assets in, and then this is how the 114 information partially is reported on the 1040, but 114 is separately filed, and 8938 goes with the tax return. So I do want to share with you. There is a link. There's a great. I think this is one of the great things that IRS has done, which is a comparison of Form 8938 with the FBAR. This is the FinCEN Form 114. So this is 114, and then foreign bank, and this is what we're talking about in terms of reporting. All right, so this does not replace, of course. 8938 has its own obligations. Form 114 has its own obligations. I would just skim this this link through. I'm not going to go into detail, but I'm just giving you a overall overview. So technically, this is, we use this page all the time to refer sometimes. So it really it's a great comparison in terms of what should be reported, how should be reported, the reporting threshold of each type of reporting, and then what type of value, what is being reported. So to tell you, who must file the 8938, and then who must file the 114. Of course, this is if you're meeting the threshold, you file both forms. So it talks about this. If you go down, it talks about the threshold, threshold of the assets too, right? So if you were living in the US, this is 8938. And if you're unmarried, what is the total value should be? If it's at the end of the year, what it should be. That's how the reporting kicks in. If you're married, again, what are the reporting requirements? If you were living outside of United States, then we have separate reporting thresholds. For FBAR, the simple one is 10,000. So 10,000 doesn't mean one account. This is all the accounts combined. So when we're talking about threshold, these are all the accounts combined at a single point in the year. So it does talk about cumulative balance. So it meaning that if you have two accounts with the combined balance at any time, at any one time. So and this is the value. It's not talking about just the cost. It's talking about the value. So that means if you have uh, again stocks, you bought them at $10, and then now they're valued at 10,000. This is how the value is being calculated, right? So in some cases the value will be different than the cost. So this is how the 8938 and FBAR is being reported. So you should understand how is 8938 applicable to me. First of all, understand the threshold, and then the 114 form is it? So this is a great link. I'll be putting in the description too for you to access. You can just type in compare 8938 and F bar IRS, and then this will pop up. It's a very great information page. I think it's one of the few pages that IRS has done a great job. Normally, I don't give them credit. That is just my thing where I feel that they do a poor job in terms of giving instructions. So this is that's where the 8938 will come in. Of course, and this is one reporting requirements. So I know we talked about the RSP, RESP, TFSAs. We talk about non-registered accounts, stocks, crypto, you name it. This is everything covered in these foreign assets. When I say foreign assets, everything in terms of assets. Your This does not include the real estate, the any real estate. I mean, real estate are reported on a separate form. If they were a rental property, if it was a second home, that is not part of this. So, but again, you make sure that you do read the instructions, and they tell you in terms of what is an account, what is considered an asset, what is being reported. Again, maximum value. This is what they're talking about. How do you determine what exchange rate do you do? What are the due dates? So the due dates are attached to your tax returns. That's something that is very important. And then, so how do you file them? Of course, these are filed electronically within with your 1040. I do want to point, once we're done, and then I do want to say, look at the penalties. This is what I've been talking about in all my videos. What are the penalties of filing failure to disclose 8938? 10,000, and then additional 10,000 for each 30 days after the IRS notice. A 10,000 penalty for failure to disclose. Look at this. I mean, so this is not something that you should take lightly. For not reporting, $10,000. I mean, so that's crazy. I know on the Canadian side we have for Form 1161. I mean, we are talking about $2,500, but in comparison, this is 10,000 USD. And then look at the FBAR penalties: 50% of the account balances if it's willful. This is no joke here, and that's the reason I want to emphasize that filing a first year return and then filing it the right way for a Canadian in the US is so important that you cannot let someone else decide for you. Make sure you understand this, because look at the penalties. They will send this information to you. Hey, do you think everything is okay? And then you will sign it, and then you send it, but you don't know, right? You don't know. So whenever you move to a new country, I mean, make sure the first year you get somebody else to do it. And that's the reason I emphasize this. It's not for me to make money. You can go to anywhere you want to. You don't have to come to us. But find a person who can really help you. Because look at the penalties. These are huge penalties. I mean, this is just a penalty. We're not talking about tax here. Tax is a different matter. These are just penalties for not disclosing. And these are, so 50% of the account value, that's insane. That's insane. So the account values are all on one F bar. So if it comes down to be 200,000 for all the account values, the penalty is going to be 100,000. So guys, I mean, look, I'm with you. I want to save money. That's the reason I want to make more money too. That's the reason I'm coming to the United States. But at the same time, you don't know, right? You don't know is you don't know. So find somebody who can help you on both sides. Find somebody who knows this, right? And then that's the reason I've been saying this. For the first year, get somebody to help you. Do yourself a favor. Get somebody to help you file your first U.S. tax return. Once you know what is happening, if you think you can take it on, take it on. I'm up for that. But make sure that you get someone to help you the first year. I mean, again, get somebody to help you. This is 8938 versus the F bar. There's a whole instruction on there, and then you can get into details of the reporting. The next thing I do want to discuss is if you do file. Let me see. Let me talk about in terms of what are we talking about? So of course, the ITN W7 is the form for the ITN application. That I think I missed that on the first session, but it is on my screen, so I just wanted to bring that up. So once we are done with that, I mean, so let's talk about tax treaty positions and then the disclosure form. So the first year return, we do have tax treaties. with the US and Canada, then this is something that we do want to take. In some cases, if if we have disposition on the Canadian side, we have a tax treaty for that too. If we have retirement accounts, we have tax treaty for that too. And these are disclosures and positions that we gotta take on the first year return. Make sure that you take them because they are there for you to take them. So in certain times, there might be requirement of a disclosure form, which is 8275 used to disclose certain things that we're not sure of. It is a more technical form. I see a lot of accountants don't use it, but in some cases it is required. So 8838 is the treaty form that needs to be used within your 1040. So 1040, 8938, 114, uh, and then 8838. These are the forms that are, normally you would see on a U.S. first year U.S. return. You would see the disclosures too, and then of course if you have a foreign income for U.S. tax purposes that is being reported, let's say Canadian income that needs to be reported on the U.S. return, then the foreign credit, which is 1116 form that is used to take the credit. So these are the forms that are required. I do want to give an overview of it. The first time when you are moving to the United States, you make sure that you understand the reporting requirements according to your substantial present test. Make sure you understand that once you do meet the test, you do have the option to file a dual status return and a full year return. That's something that can be done. And once if you're not meeting, then of course it's a 1040 NR, a non-resident return. If you do want to get the full credit, of course, the full return. So when we are filing as a resident, we have foreign reporting requirements, we have foreign assets requirements, the 8938, the 114 forms, the tax treaty disclosures that needs to be made, the 8275. These are the forms that need to be covered. That needs to be there as well. And then, of course, if we are getting the ITN W7 form, it's a form that is used to prepare the ITN. The ITN does have a separate process and needs to be certain things needs to be certified on those. And then so these are some of the common forms that I wanted to cover with you in terms of when a Canadian moved to United States, and how the first year return should look like. And in a case of a resident return, I'll summarize this again. Uh, you need to make sure that you understand the foreign rules. Make sure you understand the foreign reporting rules, the foreign asset rules. So 8938, the 114s, the 8838, the 8275s, and then any 1116 form to get the credit. So these are things that we need to cover. Anything, if you want to reach out to us, you can reach out to us at info@akifcpa.com. And then send us with any questions you have. We can definitely help you out. I do want to say that if somebody has already moved and they didn't know about it, reach out to us too. We can, in some cases, we can help them to get the situation sorted out, get them on the right direction. In some cases, we are not, depending on how long they've been out of the. They never now have been filing. So make sure that in any scenario you reach out to a professional. Then reach out to us too. We can help you. We can guide you. If we cannot help you, we can try to send you somewhere with it where they can help you. So again, this is something that I wanted to do for a long time. I wanted to give my fellow Canadians some information when they come to the United States, how the U.S. return, first year U.S. return should look like, what forms you should see. If you're not seeing those forms, then something somewhere is messing up. So you are able to take action right away. Any questions? Again, info@akifcpa.com, and then we'll be glad to help you. Thank you.